Good morning, ladies and gentlemen. My name is Nachanon Nakdang, and today our group will be presenting about inflation and taxes. So, what is inflation? Inflation is the increase in the prices of goods and services over time, and with inflation, value of currency decrease over time. Let's look at an example. The example is the change in price of a cup of coffee over time. So first we look at the price of coffee in the year 1970. We see that the price is just 0.25, right? But 10 years later, in 1980, the price increased to 0.45. You see that the same product, but the different price and the increase in price over time. That means if you have the same amount of money 10 years before this, you cannot buy these items. That means the money of the currency has decreased. The next one is the inflation rate. The inflation rate is just the percent increase or decrease in prices during a specified period. So in this example, in the first 10 years, the price of the coffee changed for 80%. So you can say that the inflation rate for this product in 10 years is 80%. But it doesn't mean that every item's price will change for that certain percent, because this is just only an example of one product. So how to measure inflation rate in general? The most common way to measure inflation rate is to use the CPI or Consumer Pricing Index. CPI is a measure that examines the weighted average of prices of basket of consumer goods and services. So there are 8 major groups in the Consumer Price Index in this circle below, and some country may just choose some items from those groups and then put it together and then calculate the expenditure of the prices of the product. So for example, the Office of National Statistics in UK use around 700 items in CPI computation. So how do we compute it? First, we select items in the basket of goods that we are interested in. Next, we select the base year. It can be any year in the period that we want to select as a comparison year to another year. Next, we compute the CPI based on this formula, which is the CPI equal the cost of the market basket divided by the cost of the market basket B, and then multiply by 100. So let's look at the easy example on how to convert a CPI to inflation rate. In this example, we have the index type, which is one of many index types in the world. So in these index types, they have the number up to 1000. Let's look at the 2 year from 99 to the 02 year. So you can see that the CPI changed from 1000 to 1082. So that is a 8.2% change. So we can say that an inflation in the year 99 until the year 02 is 8.2%, or 4-year inflation is 8.2%. Next, we are going to talk about we are going to give an example about how to compute the CPI starts from the beginning.
Hi, my name is Anita จินกับพนิชการ and now I will show you how to calculate the CPI and inflation rate. Firstly, we need to know how much of each good and how many were purchased each year. For the example, we consider in 1984. From the table, you will see that the price of hamburger is $0.8 and $24 for jeans and $5 for movie tickets. And the quantity is 40 for hamburgers, 1 for jeans, and 4 for movie tickets. Then we have to find the total expenditure by multiplying price times quantity and adding them together. So we get 0.8 times 40 plus 24 times 1 plus 4 times 5. The result is $75. After that, we consider 20 years later, which is 2004, and we assume that the market basket stayed the same in 2004 as it was in 1984, and the only thing that changed are prices. In 2004, there are $1.2 for hamburgers, $30 for jeans, and $7 for movie tickets. And then we calculate expenditure in 2004 by use 2004 price and 1984 quantity, which is 1.2 times 40 plus 30 times 1 plus 7 times 4. The result is $106. To find CPI in any year, we have to divide the expenditure in year T by the expenditure in the base year and times 100. So CPI in 1984 is 75 divided by 75 and times 100. The result is 100. And CPI for 2004, we will take expenditure in 2004, compare it to the expenditure in 1984, which is 106 divided by 75 and times 100. The result is 128. And now we can calculate the inflation rate by use CPI. The inflation rate between 1984 and 2004, which is 128 minus 100 and divided by 100. The result is 28%. From the result, it means that the price have risen by 28% over the 20-year period. Moreover, we can calculate the average inflation per year, which is 1 plus 28% to the power of 1 over 20. The result is 1.012%.
Hello, my name is Sidali, and in this part, I'll be talking about how important inflation and how related it is to take investment decision, as well as to borrow money from banks or other institutions. So the first part would be why inflation is an important consideration in all investment decision. It is really important to know that when inflation is presented in a society, that means things will get more expensive. Therefore, people tend to spend less, and because of the fact that interest rate goes up, money will be difficult to borrow from banks, and as a fact or as a result of this, companies usually don't do well when inflation is presented, due to the fact that people don't buy a lot of goods and services because there's a lot of uncertainty in the market, and therefore the share price of the company goes down. However, it is quite attractive to people to invest in what we call risk free investment in such a situation. You can think about it like investment in treasury bonds or
other alternatives. In the next point, I would like to talk about how inflation affects a borrower's ability and willingness to borrow at a specific rate. Usually, lenders require borrowers to pay them a higher interest to compensate for the loss in purchasing power over the term of the loan. You can think about it this way. If you have $10 and you are planning to buy an item that costs you $10 now, and you have an idea of lending that money to someone and he will pay you back $12 in 2 years' time. If you believe that the item you are buying will be at the same price in 2 years' time, that would make it attractive to you to lend the money to the borrower and make that $2, because eventually you would be able to buy the article or the item at a $10 price. However, when inflation takes place in the society, items tend to increase in price. So if the inflation rate, for instance, is 3% and you're about to buy that item, when someone approaches you to lend him the money and get a return of $2 in 2 years, when you calculate, you would find that you will have a loss in purchasing power. That means in 2 years' time, if you happen to go and try to buy that item, it will cost you more than $12. So there's no benefit of lending money at a lower interest rate when inflation is presented in a society. And here are two equations to show the repayment amount of a loan in a world of no inflation. So you can see that the payment will be P0 multiplied by exponential RT, where R represent compensation for deferred consumption. However, the repayment amount of loan in a world where inflation is known is P0 exponential R plus I, the whole thing multiplied by T. And here I is not the interest, but I represent the certain rate of inflation.
Hi, my name is Panvita Leewongjalern 6005540. I will show you how to find the real rate of return.
Question number 1. If the rate is annually compounded, we use the first method, which is apply the formula that 1 plus nominal rate divided by 1 plus inflation rate and then minus 1. If the rate is continuous compounded, using the second method, real rate plus inflation rate equal nominal rate. But all of our problem, the rate is continuous compounded, then we can use the second method. This problem we have nominal rate 13% and inflation rate 3%. We can find the real rate by taking 13% of nominal rate minus 3% of inflation rate. So the real rate is 10%.
Question number 2. We have real rate 13% and inflation rate 5%. We want to find the nominal rate. We can find the nominal rate by taking real rate 13% plus inflation rate 5%. So the nominal rate is 18%.
Question number 3. Use the nominal rate of question number 2. We have nominal rate 18% and inflation rate 2%. We can find the real rate by taking 18% of nominal rate minus 2% of inflation rate. So the real rate is 16%.
Question number 4. Explain from the picture. The borrower have to pay 9% to the lender, no matter what the inflation rate increased or decreased. For this problem, the inflation rate is decreasing. On the other hand, the real rate is increasing. Therefore, wealth transfer from borrower to lender.
My name is Kate Kelkamon 6005622. Today I will talk about the real rate of return. The real rate of return is an annual percentage return realized on an investment, which is asset for change in price due to inflation or other external factor. Firstly, we will begin with the real rate of return that has already inflation rate. In this case, the real rate of return will equal to a nominal rate subtracted by inflation rate. For example, assume your bank pay your interest of 5% per year on the fund in your saving account, and if the inflation rate is 3% per year, so the real rate of return on your saving is 2%, which means that the real value of your saving only increased by 2% during a 1-year period. And another example, assume that an investor might earn a nominal return of 12% on his stock investments, but the money that he gets at the end of the year will be less than 12%. Inflation might have been 3% for the year, so his real rate of return down to 9%. And from this example, if he wants to sell his stock at a profit, he will have to pay tax on those profits. But how to calculate the tax for the real rate of return? First of all, we have to determine the after-tax return before inflation, which is calculated as nominal return multiplied by 1 subtract by tax rate. For example, consider an investor whose nominal return on his investment is 17%, and his tax rate is 15%. We will find his after-tax rate of return before inflation by using the formula above, so his after-tax rate of return is 14.45%. Next, we can calculate the after-tax real rate of return. The after-tax real rate of return is the actual financial benefit of an investment after accounting for the effect of inflation and tax. It is a more accurate measure of an investor's net earning after income tax have been paid and the rate of inflation has been adjusted for. Both of these factors will impact the gain an investor receives, and so must be accounted for. To calculate the real rate of return after tax, divide 1 plus the after-tax return before inflation by 1 plus the inflation rate, and subtract all by 1. For example, assume that an investor whose nominal rate of return on his investment is 17%, and his tax rate is 15%, and the inflation rate during this period is 2.5%. We will use the formula from previous slide. So the after-tax real rate of return is 11.66%. As long as the real rate of return after tax is positive, an investor will be ahead of inflation. If it is negative, the return will not be sufficient to sustain an investor's standard of living in the future.
Hi, my name is Strat. Next, I'm gonna talk how to calculate the after-tax real rate of return. The after-tax return before inflation is nominal return multiply 1 minus tax rate. Example, consider an investor whose nominal return on his equity investment is 17% and his applicable tax rate is 15%. We can calculate after-tax return by this formula. We have nominal return is 0.17 and tax rate 0.15. So after-tax return is 0.1445 or 14.45%. Next, the after-tax real rate of return by considering the inflation rate. Real rate of return is 1 plus nominal rate divided 1 plus inflation rate and then minus 1. For example, Miss So has kept 100,000 in a bank. The bank promised to pay 6% rate of return at the end of the year. The inflation rate is 3% during the years and tax rate is 7%. What would be the real rate of return? First, we should calculate nominal rate. Nominal rate is 0.06 multiply 1 minus 0.07, and then we use real rate of return formula. We have inflation rate is 0.03. So real rate of return in this situation is 0.025 or 2.5%.